So usually when we do these market updates, we'll send out an email or publish them on our blog or through social media. But we made a decision to try more and more to incorporate video. So I hope this format helps. And with that, let's get into it. Suffice it to say, this has been a very strange market. And historically speaking, it does happen every now and then. This one is definitely acting weirder and taking longer than I thought it would. And I wanted to go into what I'm thinking about the market these days and how we intend to manage your money accordingly. So, where are we today? The S&P, it's risen about 20% year to date. The NASDAQ is just blowing it out of the water. And of course, it's all sunshine and rainbows and clear skies ahead. Except it isn't. As you know, I'm always thinking risk first, then return. And it's like the Warren Buffett rules. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So I want to bring up some perspectives for you to keep in mind. When we buy something, I'm thinking of 2 things. I'm thinking of price, I'm thinking of earnings. It's pretty simple. So here's the S&P 500 on a price earnings multiple going back several decades. Maybe it looks like we're on the high side of things, not terribly overvalued. That said, I prefer to look at things inflation adjusted because especially today, inflation matters. So let's take a look at the same chart while factoring in inflation, and all of a sudden, things look very different. So this chart is the CAPE ratio, or the cyclically adjusted price earnings ratio of the S&P 500. I want to note that valuations today, based on this metric, are as high as they were before the 1929 crash, which of course kicked off the Great Depression and the dot-com boom and bust in the 2000s. That is where we are today, inflation adjusted. Let's take it even further. The yield curve, which is a pretty darn good indicator of past recessions, is super inverted today. You can look at the 2-year, 10-year, the 3-month T-bill, 10-year treasury, seems to be maybe even a better indicator or better predictor. But in either case, an inverted yield curve has preceded a recession every single time going back to the 50s. Then you have the so-called Buffett indicator, which Warren Buffett himself called one of the best metrics out there for valuation. It's the total stock market, or the Wilshire 5000 divided by GDP. This is at staggering levels today, as you can see. We have the Conference Board's leading economic indicator index. Leading because, like Wayne Gretzky said, I don't go where the puck is, I go where the puck is going. So the leading indicators have been declining 14 months in a row, definitely in recession territory. It has a 100% track record, right? Not 20%, not 50%. It's got a 100% track record in predicting recessions. And lastly, I want to talk about interest rates. There is a 12 to 18 month lag that really hasn't even hit yet. You have to remember, the major interest rate hikes happened last June onwards. So we have yet to see the full effects of those rate hikes. And just as a reminder, this is the fastest interest rate hiking cycle in Federal Reserve history. We've never seen this quick of a pace. So with all these considerations, it is just difficult for me to get excited about investing in the stock market at these valuations. You know, we may miss out as a result. When I watch the financial news networks, everybody's happy, everybody's in a good mood, everything seems hunky-dory, but it just seems like a mania to me. So is the market going to keep climbing higher for the remainder of the year? It could. You know, manias are hard to stop once they get started, and I never ever want us to chase returns because that usually does not work out. And it's possible we'll continue to go higher from here, and it's possible you'll see people around you, your neighbors, get rich. For now, there's always a reckoning, right? You can push valuations only so high until something breaks, and the earnings, the fundamentals just can't justify those valuations anymore. So in the meantime, patience is key. We're getting a pretty decent yield in short-term treasuries, and will likely stay there until this market starts to make more sense to me. If the S&P, let's just say the average S&P 500 historical return is, say, around 9%, I mean, we're getting a 5.5 on T-bills. No risk. You'd have to have the U.S. government default on its debt to really be concerned. And if the U.S. government defaults, the equity market is going to be in far worse shape. And I know many of you have some sizable cash positions in your portfolios. Keep in mind, we're still collecting a pretty good yield on that. Interactive Brokers gives us like a 3 to 4% yield on the cash itself. So all said, we're getting roughly 50-60% of the S&P 500 average annual return with no risk. And I'll take that any day. Eventually this mania, whatever is driving prices higher, it's going to reach some ceiling, and like every boom, there's going to be a bust, most likely. So going back to our initial question, is it possible this time it's different? Is it possible that we'll miss out? Maybe it's different, and maybe we'll miss out. And then again, maybe it isn't. And when we have so many indicators flashing red, I have to do the reasonable and prudent thing here, and that's what we're going to do. So keep in mind, the lag effects of those interest rate hikes, they should start to kick in relatively soon. I mean, it's hard to forecast exactly when that will happen, but I am starting to see some cracks form in corporate earnings and the labor market because the cost of capital is just much higher. So the average recession drawdown is pretty substantial. Some of them are on the mild side, some of them on the severe side, but in either case, I want to avoid this as best as we can. Anyways, that's all that I have for this market update. On another note, as you can probably tell, we're officially launching our new YouTube channel in the next several weeks or so with regularly published videos. I've just realized that when it comes to financial independence and retiring early, there's an educational component and element involved. And so many of our videos are going to be really focused on teaching all of you how to develop that mindset, building the savings muscle, delaying gratification, cultivating the right mental habits, all the things that are needed to walk this road to financial independence. So a lot of effort has gone into these, and my hope is that we can really, get the ConCap message out there by doing this over time. And I have a favor to ask all of you. Please watch them and put some comments, put some feedback in the comment section below. I really consider myself a beginner speaker. I'm getting coaching, believe it or not, on how to do this better. But I know that I have a long way to go. And you all can help me expedite that process by giving me some honest feedback. If you really like the videos, comment below. Tell me what you liked about them. If you see areas of improvement, let me know what I can improve on in the comment section as well. You'll actually see a pinned comment at the top of every video, the comment section, asking for feedback from all of our viewers. And it's probably going to be there for the foreseeable future because I know I'm getting started and then I can use all the help that I can get. And then if you watch the video and you really like what you're seeing, you found it informative, you found it helpful, share them on your Facebook and Instagram feed so we can get more traction to our channel and to our website ultimately. It helps with the algorithms, it helps with the overall growth of the video channel and ConCap. In regards to exactly when we're releasing our new videos, at the moment, we're targeting sometime in the middle of September. If you haven't already, go ahead and subscribe to our channel, hit the bell icon so you can, stay in the loop and you'll know exactly when they're released. Anyways, that's all for now. Be well and stay focused on what you can control, which is developing your savings muscle. And I'll see you next time. Thanks for watching. If you like this content and found it helpful, feel free to share this with your friends and family. And don't forget to hit the like button, subscribe to our channel, and hit the bell icon so you get notified of new videos as they're released. And if you've made up your mind, you've decided you want to become a client and start on your road to financial independence, head on over to our website and fill out the requirements form. The URL is listed in the description below. Thanks, and I'll see you in the next video.